Hi, I'm Steve Breen with Prosperion Financial Advisors. Welcome to this edition of Prosperion. To celebrate my 60th birthday, my team here gave me an incredible gift. It's a book of the New York Times front pages for each of the last 60 years. A great gift indeed, but also a reminder of the words, "The more things change, the more they stay the same." Indeed, the more we think things have changed, the more we are reminded they are the same. Ah, yes, it's fun to flip through this. Reading through the headlines over the last 60 years, I was struck by the familiarity of the messages. Frankly, I thought the headlines were from just yesterday, not 5 or 6 decades ago. The patterns seem all too familiar. Let's see if any of this rings a bell with you. The media openly criticizing and bashing the president. Mudraking over the political journalism. Boy, does that sound familiar in today's political season. The hand-wringing about the unemployment rate, welfare beneficiaries not willing to work or even interested in working. The negative comments about business trade with countries that may not be terribly friendly with us, such as the USSR, Russia. The European economy being in a slump, peace talks in Israel, the testing of atomic bombs, enemies firing on our naval vessels, yes, Russian MiGs firing at naval boats near Cuba, embassy bombings. Another way of phrasing all of this is history repeats. If not, boy, it sure rhymes. Consider the first 6 weeks of this year. The chatter on the likelihood of a soon-to-be bear market. I truly believe financial companies that stand to benefit from investor uncertainty, like those large investment firms, fund companies, insurance product companies that manufacture products, actually manufacture stories in an effort to increase their share of selling their products to investors. I believe part of their business model exists to raise doubt in investors' minds, then creating their solution, selling investors something that is new. Usually it was back-tested, or more often than not, selling what happened yesterday. They rely on people believing that past performance could indicate future returns. So they buy what went up last year and focus on strategies that could have had great returns. Nearly every piece of financial marketing material says at the bottom, past performance is no guarantee of future results. Yet no one seems to pay attention or believe these disclaimers. Such a shame. Remember Money Magazine and how they would actually tout investors into buying last year's top performers. Good for selling magazines, potentially very detrimental to investors' net worth. So, are we going to have a bear market or not? Well, frankly, I don't know. In nearly 40 years of advising clients and investing their money, I've never found a way to predict short-term direction of the financial markets. If I could, I would, and we would be a whole lot richer, all of us, as a result. What I do know is illustrated by this chart. In the last 70 years, since World War II, there have been 14 bear markets highlighted by the red bar lines. According to my calculator, that works out to be 1 every 5 years, 70 divided by 14. Downturns have taken on average 15 months to go from the peak to the trough and have fallen on average about 30%. Not terribly comforting, but welcome to the real world. Since 1940, temporary drops of greater than 30% have happened pretty much every 5 years. And you know, for the average two-person that's going through a 30-year retirement period, that's about 6 times. Over this time, it was a repeatable pattern of equity investing. Now you can choose to avoid equities. We believe the consequences of not being an equity investor will have serious ramifications on your retirement income. Here's another way of looking at price fluctuation and the purchasing power risk with this chart. Notice the gray line. That represents equities, and it illustrates a lot of volatility or price fluctuation. We've seen, on average, a return of approximately 10% per year. Now, the yellow line, or bonds, illustrates far less volatility. And this has returned about 5% per year. Less risk, less reward. Notice the green line, which represents our money market funds. They've averaged about 3% per year. Stable in price, yet low return. And notice the red line. And notice how it slopes lower. That illustrates the impact of inflation. You'll notice this is approximately the same number, or 3%, as what money market funds have earned. But certainly we haven't seen money markets pay 3% in the last 7 or 8 years. What some investors might consider to be a safe investment is all but safe when you consider the impact of inflation on your long-term cash flow and therefore the purchasing power of your money. Money markets may be secure as they have little fluctuation, but clearly they are not safe when you consider inflation or purchasing power risk. Inflation is the biggest risk investors face, especially over a 30 or 40-year time period, which is the likely time horizon for a couple that enters retirement at age 65. Inflation and longevity are retirees' biggest risks. It's not volatility. Think of inflation as a hill we all must climb. Ignoring its effect on purchasing power can derail your financial plan. This is why we believe it's essential for investors to have rising income that increases at a rate greater than the inflation rate. If not, you're getting poor slowly, and you won't notice it until it's too late. If you'd like to have a conversation about our investment philosophy or strategies, feel free to contact us. Likewise, if you know a friend or a family member who might benefit from understanding the impact of inflation and investment return, please forward this video to them. We welcome the opportunity to help others toward having enough and to protect their purchasing power. I'm Steve Breen. Thank you for being a client of Prosperion Financial Advisors.